Okay, yeah, welcome back, everyone. So let's start our class from where we stopped in the last period. In the last period, we looked at intangible assets on IAS 38, and we saw a great similarity with IAS 16. We looked at these areas, and particularly we saw that when it comes to recognition, measurement, the recognition, disclosure is absolutely the same with the requirement in IAS 16, except some few areas that we clarified. Of course, the definition was very different. We explained identifiable, we explained non-monetary asset. Then when it came to recognition, we saw that it's exactly the same as that of IAS 16, but we said recognition is determined by how you have bought the intangible asset. We looked at where you purchased it, where it is internally generated, and we looked at research and development. Basically, the internally generated intangible assets are not recognized in the books unless it is acquired in a business combination. So you don't recognize it in your books at all. But if you had bought another subsidiary or another entity, and part of the assets you bought in that entity or you paid for is that entity's internally generated intangible asset. So in that wise, the parent can recognize such an asset in its consolidated financial statement. So that is where you find items like brand name, customer list being recognized in the consolidated financial statement. Then we also looked at research and development, which are also internally generated intangible assets, except that they are project specific, which is why we're able to class the cost into research and development costs. Research costs are expensed. Development costs are capitalized if they meet these 6 criteria, which means that before they meet these 6 criteria, they are usually expensed. So that means that there are some development costs that are expensed. And indicator, what shows that these 6 criteria has been met is the existence of a board approval or regulatory approval. These two show that we have met these criteria. And the measurement is also similar to that of IAS 16. Initial measurement is at costs. The component of this cost is the same as that of PPE. Subsequent measurement is also the same as that of PPE in terms of cost model and evaluation model. Just that we mentioned that before you can use evaluation model for an intangible asset, there must be an active market for that asset. If there is no active market, you cannot use the evaluation model. And you find out that most intangible assets have an indefinite useful life. And I quickly made you know that indefinite is different from infinite. Indefinite means that we don't know the useful life. We cannot see the end. Not that it doesn't have an end. It has an end, but we cannot reasonably determine it. But infinite means it does not have an end. The life will not end. That's infinite. So the useful life here is indefinite, not infinite, right? So when you have an intangible asset with an indefinite useful life, you cannot amortize it. What you do is to test them for impairment annually. And we looked at some intangible assets. We learned how to classify them. Should we expense them or should we capitalize them? We looked at website cost. We said, yeah, it depends. It depends on the purpose of the website. If you have a website that is just displaying your information, just like marketing, just like a banner, right? You expense the cost of developing such a website. But if you have a website that directly related to your revenue generating activity, that all your buying and selling, that's where it happens. Like a company like Jumia, like banks, for example, where you'd go to their website to do transfer and all of that. So it's really related to their core activities. That's where the activities are carried out. Yeah, so such cost in developing such an app or a web app, it's it's an intangible asset. So we looked at staff training. We said these are expense, cryptocurrency. We said these are intangible assets. And we discussed about footballers, that human beings are not assets. We cannot put human beings in our books, but the acquisition cost of a footballer gives the club a registration right over the footballer. So yeah, that registration right is the intangible asset. Then that was it. Basically, we solved some questions and I gave you assignment. Right. So I mean, I have like 5 people did it. 5 of you did the assignment, which is okay. Because of the period that is short, quite a number of you haven't done it. So let's quickly discuss it. So we're asked to discuss two measurement models, cost model, evaluation model. So cost model, cost minus accumulated depreciation minus accumulated impairment losses. Evaluation model, evaluate the amount of fair value minus subsequent accumulated depreciation minus accumulated impairment losses. Now, the B part asks us to calculate with explanation. So I saw that all of you just calculated. So in the exam, you would not get your full mark because you did not explain. So you need to read the question with particular attention. In fact, before you read the main body of the question, read the requirement first and understand it. Don't just read. Take your time and understand what the guy is wanting you to do. This one, he wants you to calculate, but with explanation. So don't just calculate, explain every of your calculation. So we're asked to calculate the carrying amount and evaluation surplus of the intangible asset at these different dates. First, December 2019, second, 2022 before revaluation, and the same date after evaluation. Averagely, each takes 3 marks, so a total of 12 marks for the 3 dates. So what's happening? What's happening is that Oluomo Taxi Limited financial year end is December 31st. The company adopted evaluation model for its intangible assets and evaluates them on a regular 3-year cycle. However, for intangible assets with a finite life, Oluomo Taxi Limited transfers the relevant amount from evaluation result to retained earnings. Okay, none of you did this. Those of you that did this, you did not consider this at all. So you calculated evaluation surplus, but you did not transfer to retained earnings. And I taught you this in IAS 16. It applies here too. It applies here too. So that's their policy. Now, in 2019, so this company incurred 700,000 on the process of preparing an application for licenses for 15 taxis to operate in an holiday resort very close to Abeokuta. In order to prevent congestion and excessive traffic pollution, the licensing authority only allowed a small number of taxis to operate. Okay, so he's applying for license. So he needs 15 taxis, right? So he paid a registration fee of 700. Now, the next paragraph, they say the outcome of the company's application was uncertain as of November, when the local government, up to November, right? So when the local government authority accepted the application. So in December, He then incurred 90,000 to register its licenses. So the licenses were for 9 years from January 1st. Okay. So the licenses are freely transferable and an active market in them exists. So the fair value at December 31st, 2019 was 94,500 per taxi. And Oluomo Taxi Limited carried them at fair value in the statement of financial position at this date. In 2022, he carried out a evaluation, and on that day, the licensing authority announced that it would triple the number of licenses offered to taxi operator, and there were transactions in the active market for licenses which are 6 years to run at 45,000. Okay, interesting. So, yeah, he's trying to get a license from the government. Initially paid 700 for 15 taxi rides. So this 700 he paid, he's just to apply. So he wasn't sure whether the application will go through until November. Until November when they accepted his application. So in December, he then paid additional 90,000 to register his licenses. Okay. So for this paragraph alone, one, this 700,000 will be expensed. Somebody got this right. Most of you got it wrong. You're capitalizing the 700. You cannot capitalize 700 because it doesn't have regulatory approval. But at the time he incurred, he wasn't sure until November. So any cost incurred prior to this date will be expensed. Any cost incurred prior to this date will be expensed. So this 700,000 is definitely going to be expensed. However, in December, he spent 90K to register the licenses. All the licenses, he only spent 90K, right? And they gave him, and he would have 9 years from the next year, counting from January 1st, 2020. So this 90,000 will be capitalized as an intangible asset. So only 90,000. The 700K will be expensed. Additionally, so there is an active market for the license. Yeah, that is why you can use evaluation model. If there is no active market, you can't use evaluation model. So they were able to get the fair value as at that December as 94,000 per taxi. And so he carried it at fair value. So a lot of you didn't see this per taxi. You just treated this 94,000 and you were working with that. So ordinarily, the fair value of this license as at December 31st, 2019 is actually 94,500 multiplied by 15. Whatever you get, that's the fair value. The book value, the carrying amount is 90,000 as at the same date. So the difference is a revaluation surplus. The difference is a evaluation surplus. So, and that evaluation surplus, you then need to calculate this excess depreciation that you need to transfer every year. You need to transfer every year over the remaining life of the asset, like that. And that's what happens as at 2019. So as at 2022, before evaluation, it's just for you to calculate depreciation for 2020, 2021, 2022, calculate depreciation, deduct it from that fair value to get the new carrying amount. However, the carrying amount after evaluation is just for you to, okay, what's the new fair value? Is 45 multiplied by 15. That's the new fair value. You compare that with the carrying amount as at the same dates to get whether we're having a deficit or surplus. So to manage our time, I have the solution here for you. And you see that I was explaining, I was not just calculating. If you look at it, I explained that the 700,000 incurred on the process of preparing application for license for 15 taxis will be expensed. This is because it is not probable that future economic benefits will flow, since the question mentioned that the outcome is uncertain as of November, up to November. So then I went ahead as of 2019, the carrying amount of this license will be the fair value at that date. Since the entity uses a valuation model, then I multiply that 94,000 times 15 to get this. I told them that the cost of the license is 90,000. And I said, this is the only cost that meets the recognition criteria as at December. So the surplus, the evaluation surplus, therefore, is the fair value compared with the carrying amount. So we have the evaluation surplus of this as at this date. Now, as at 2022, the carrying amount before regular evaluation is this. So it's just for me to do the value minus my accumulated amortization. So since it has a 9 years and it will have used 3 years as at this date, 2022, because it came up in December 2019, so 2021, 22. So I can use this to determine the accumulated amortization. This gives me the value as at 2022 before evaluation. Now, after evaluation, it's just for me to get the new fair value times 15. So is that straightforward? So I then get a revaluation surplus or deficit, which compare the carrying amount as at December 22, which is 94,945 times the fair value. In this case, the fair value is lower, so we have a deficit. We had a deficit. So I now say that, remember that there was a evaluation surplus as at 19, which will be in reserve as in equity. And it's the company's policy to transfer reserve to retained earnings. So the balance after the transfer, they will have transferred for 3 years. The transfer is per annum, right? So that surplus, they will have transferred a cumulative of this, because the way I taught you, I said is the surplus divided by the remaining useful life, which was 9 years. So they have transferred for 3 years. So cumulatively transfer the total of this. So in such a way that as at the end of 2022, the balance in the reserve will be this, because they will have transferred quite a lot out. Now that we have a deficit this year, this deficit is not going to go to P&L, because there is an existing reserve of 885 in equity. For that reason, this deficit will be debited to OCI to net off against the previous or earlier evaluation surplus. That's all for that question. So it's a very nice question. It teaches you a lot of these principles that we have talked about. I will share the note with you just so that you can also look at it later on. Okay. Let's have it. So I have some hands up. Yeah, who wants to go first? Anyone can go first.
Okay. Yeah. Good evening, sir.
Evening.
Yeah, I got well, I didn't submit actually, but I got most of the parts right,
I'll share
except
it.
for this 90,000 registration fee.
Yeah,
When I saw that the revalued amount, I mean the fair value is 94.5. So it dawned on me, I felt that the 90,000 for all the 15 is unreasonable.
it's too small. Yeah,
So so
I
that
get
was but there was nothing actually to tell me that 90,000 is actually for everything. I don't know.
Yeah, but there was nothing to tell you that it's per taxi. So you cannot assume the one that was for per taxi. I mean, the examiner was so specific, like for this guy, it was very specific that for each taxi. So this one, they said it paid 90,000 to register its licenses.
When I
It's
thought
very,
licenses. Okay.
yeah, it's actually very good. Yeah. Yeah, nice one. You say you got most of it, so yeah, you will have gotten out of that 12, maybe you will be doing like maybe 7 or 8. Yeah. Um, Mustafa.
No, it was Mustafa that you finished with now.
No,
Ah, okay, just finish.
I was the one actually, but my question has been answered already. I was thinking the 90,000 supposed to be multiplied by
15.
15 taxes, but you have already answered it while trying to answer the other person. Thank you.
All right, all right, all right. Okay. Yeah, nice one. It's good to know that you did it and you're able to follow very fast. Now, the second one, yeah, which is this. So basically, uh, my focus is not you preparing all this because it's not even the complete question. I just extracted these two additional information. Just hoping you'll be able to adjust it properly. So let's look at it. Now, the first additional information says that as at the end of the year, which is December 31st, 2020, a valuer based in VI, Lagos, was contacted by the company to review its land and building. The land and buildings was revalued upward by 13 billion, and a certificate was issued to this effect. The board of directors approved the valuation, but it has not yet been accounted for in the trial balance. The valuer advised that the remaining useful life of the asset is reasonably and reliably estimated to be 20 years. The position is so. This is very straightforward. So there was a valuation surplus on the land and building, and from the trial balance given as at the end of 2020, the land and building cost is 62,000. And yeah, so that means the cost is going to go up from 62. You just need to add this 13 to get the new value of the land and building. So that would be 75. And was there accumulated depreciation? No. Yeah, there wasn't. So after getting the 75, you then divide it by 20 so that you can get the subsequent depreciation, because anytime there's a evaluation, depreciation starts over. So, and I did the solution here for you, which is this, the land and building, the cost, there was a evaluation surplus of 13, bringing the value of the asset to 75. Then my subsequent depreciation, I did 62 over 20 years. And the reason is that this evaluation happened at the end of the year. It happened at the end of the year. So when you want to depreciate, you would not consider it because it's the depreciation is for the whole year. So depreciation, you cannot, an asset that I just bought this year, a value that just came up at the end, you cannot consider it for depreciation for a whole year. So which is why I only consider the 62 to get my first year depreciation. So in subsequent years, then I can factor in the entire 75 for subsequent year. But for this current year, it's only the 62 that would be considered. Yeah, that's that. The second one, depreciation on plant and equipment is charged as 15% on reducing balance basis. The multi-user X and P Sage was bought on, yeah, so before I go to multi-user, right, let me clarify this. So depreciation on plant and equipment is charged at 15% on reducing balance. So we have a plant and equipment costs of 50,000. There is accumulated depreciation on the plant and equipment of this amount. So we need to calculate the carrying amount by doing 50 minus 13,875. Then whatever I get, I apply 15% on it. And why I'm doing that is because depreciation is on reducing balance basis. And I taught you that when depreciation is on reducing balance basis, the rate is usually applied on the carrying amount. So which is this? So the cost minus accumulated depreciation opening brought forward. I got my carrying amount. Then my depreciation is on that carrying amount, 15% on this to get my depreciation for the year. And then I get my carrying amount, right? And now they are talking about an intangible asset, multi-user S&P and Sage. It was bought during the year in September 30th, 2020. So the amortization rate is 12.5% annually. The amortization is evenly distributed over the year. You see this paragraph, this sentence, the amortization is evenly distributed over the year simply means that when you're calculating amortization for these assets, you only do 3 months. That's October, November, December, because it was acquired at the end of September. So, and that's because they said the amortization is evenly distributed over the year. So that means you're supposed to prorate amortization. Okay. But if they have told you that the entity charges amortization on full year basis, which means that even if you buy the asset during the year, you still charge full year depreciation. In that case, there won't be need to prorate. When they tell you that it's evenly distributed, meaning they really want you to prorate. We saw a question like that previously. We're also told that besides that software installation customization and handling cost of this, training cost of this, consultancy cost of this, another general overheads of this on the new software included in admin. So all of these costs were included in admin. So should they all be included in admin? No. Installation, customization, and handling should not be in admin. So we need to remove it. It should be capitalized. Training costs, it should be capitalized. It should not be in admin. Consultancy fee is similar to professional fee. Yeah. That should not be in admin. It should be expensed. So, yeah, training cost is okay to be in admin because it's expensed. General overhead is okay to be in admin, so it's fine. So the ones we need to remove from administrative expenses are this customization of 800 and this consultancy fee of 600 needs to be removed from admin and added to the multi-user S&P Sage software, which is what we did. So I added this customization and consultancy fee. I added it to admin cost, sorry, to the cost of the asset. Okay. And I applied my depreciation on 6,300, 12.5% times 6,300 times that. And how did I get this 6,300 is wrong? It should be 7,100, which is the total
Yes, sir.
cost of the. Yeah. So if you apply it, how much would I give you? Twelve point 5% times 71 times 3 over 12.
Eight.
Largely. Have you done times 3 over 12?
No.
It's 222.
Mm-hmm. Yeah.
Yes.
So then if I remove that from my cost, it gives me this, which is okay. And you see that I then remove those items from admin, remove cost, consultancy and customization. And all the depreciation that I've calculated, I added it to admin. So I just did an extract of P&L. So don't really focus so much on this for now. This is still going to I'm still going to do like 2 or 3 classes for you unpublished where we'll solve questions like this, but that will be around April. That's for April, not for now. So you can just look at it and see. All I'm just playing around with is just this trial balance. But the core thing I need you to notice how to really get these figures, the depreciation and the carrying amount for each of the item class. Okay. Now, that is IAS 38. You see that is intertwined with IAS 16. They're actually intertwined. And the explanation I've done for you has really helped you to distinguish it from IAS 16 in some areas, like those internally generated intangible assets, research and development, indefinite useful life, and the rest. Now, another one that is very related to what we have been doing is IAS 36. So it's also very related to what we have done so far. So those 3 are sequential. And another reason why you should believe they are sequential is the fact that when you want to calculate the carrying amount of PPE, for example, is cost minus accumulated depreciation minus accumulated impairment losses. So the reason we haven't talked so much on impairment losses is because that is covered by another standard called IAS 36. And the reality is this. So the objective of IAS 36, right, is to really to ensure that an asset or an entity does not overstate the carrying amount of its assets. So that's the objective. It's just to ensure that you don't overstate the carrying amount of your assets. So, and for us to do that is to ensure that the carrying amount of an asset is not more than its recoverable amount. So when this happens, the assets should be described as impaired. So if it happens that the carrying amount is higher than recoverable amount, then you should prescribe the asset as impaired. So that's the objective. That's what IAS 36 wants to look at majorly, that don't overstate the carrying amount of your assets, right? And what do we mean by don't overstate? It's just ensuring that the carrying amount is never more than recoverable amount. It should not. If that happens, then you'd prescribe the asset as impaired. So there are things I really need to clarify. One is, which asset are we talking about? Because asset is plenty. So the scope of this standard. So the assets, this standard deals with are majorly non-financial assets, like non-financial assets, or which IAS 38 calls non-monetary assets. So it deals with property, plant, and equipment. It deals with intangible assets, PP, intangible assets. So those are majorly the ones I've actually taught you so far. So it does not cover assets like that are majorly financial assets. It does not cover financial assets. It does not cover assets under IAS 2 on inventory. It does not cover inventory. It does not cover deferred tax assets. It does not cover that. And some, majorly this, it does not cover those. So it focus majorly PP, and it does not even cover investment property, because investment property is really measured at fair value. So IAS 36 really does not deal with it. So yeah, these are the assets that IAS 36 wants to look at. Now, aside the assets, you all know what carrying amount is. You all know that carrying amount, this is the costs or revalued amount of an asset less accumulated depreciation less accumulated impairment losses. We all know that already. Now, we also mention recoverable amounts. And recoverable amounts, this is the higher. This is the higher between the fair value less cost to sell and the value in use of an asset. Is the higher between them, and whatever is higher between this fair value less cost to sell and the value in use of an asset that's what we call recoverable amount. So, and you know that fair value, this is the amount that is received to sell an asset or paid to transfer a liability in an orderly transaction. Between market participants and the measurement date. So majorly this is like the selling price of the assets. So this is like the selling price of the asset. So we can see this. So if the fair value is higher, then recoverable amount is like how much you can get from selling the assets, right? The amount received to sell. While value in use, from the name, the value you get from using, that's what it means, really. What's the value you will get if you continue to use this asset? That's value in use. So it's usually the present value of the future cash flows, future cash inflows. Let me be specific. Core cash inflows that can be generated from the continuous use of an asset. So if you want to get the value you will get from continue to use an asset, including its deposits, from its eventual disposal. That is value in use, the PV of future cash flows, right? And you see, in reporting, at any point in time when we mention future amounts, you would need to present value it. So when you do the present value of all future cash flows, future cash inflows, in fact, future usually is even net cash inflows. But I've seen a question where the examiner gave you some encumbrances, some outflows that needs to be made on the assets. And a lot of students didn't deduct the outflow to get a net cash flow before discounting. They just use the cash flow as given, gross like that. It's not gross cash flow. It's actually net after you have deducted all necessary items. And I've seen a diet where they give you inflows and they give you taxes. So you're supposed to even deduct taxes. It's net cash inflows that we are looking at. So you discount all of this to present value, including proceeds from its eventual disposal. So they can even give you that, okay, at the end of the useful life of this asset, you'll be able to sell it for this amount. You need to discount that also to present value, right? Because it's part of the future cash inflows. So by the time you accumulate all of that, that gives you value in use. So recoverable amount to express it is more like the higher, when you pick the higher between how much you can sell an asset and how much you can get from using the asset, right? So we believe this is the realistic value of any asset. And on no account should you have a carrying amount that is now higher than this. Okay, that is higher than this. So when your carrying amount is higher than your recoverable amount, that means you are overvaluing, you are overstating your assets. It's overvalued. So you need to impair that asset. You need to reduce the value. I mean, that's all we want to do. It's so straightforward. There's really nothing much here. So that is all. Yeah. So that being said, we then can then conclude that impairment loss is the amount by which the the carrying amount of an asset is higher than its recoverable amount. Okay, so you should get a picture of where we are going, just so that we are saving time for you. So all we want to do here is to calculate impairment loss, which is very clear. I mean, you need to get a carrying amount, you need to get a recoverable amount, which is the higher between fair value and value in use. So the higher between the two becomes your recoverable amount, and you get your impairment loss. And when you get that, you will then need to use that to impair the asset. So can anyone in this class tell me what then is the double entry to account for that? Can anyone tell me when you then determine impairment loss, what's the double entry for that? So to reflect the impairment loss.
Can I try? Good evening,
Yes,
sir.
please. Yeah, hi, Sigma. Try, please.
Okay, so credit assets and debit impairment. That's P&L. Impairment expense under P&L.
That's perfectly correct. That's correct. Yeah, makes sense. However, you need to note that um, if there is a previous evaluation surplus on the same asset, okay, if there's a previous evaluation surplus on the same asset, you then have to debit OCI. Yeah, that's correct. You then have to debit OCI instead of P&L, okay, to net off against the previous evaluation surplus. It is if there is any excess over that can then go to P&L. So basically, that is all we want to do, really. So let's use some questions to just demonstrate this simple process I've explained to you now. Okay. So, Shidera, please read this question, please. Let's hear a subtle voice. Well, she's not here. Okay, not sure she's here. Um, who else can read?
Okay, let me read, sir.
Please go ahead.
A company has a machine in its statement of financial position at a carrying amount of 150,000. The machine is used to manufacture the company's best-selling product range. But the entry of a new competitor to the market has severely affected sales. As a result, the company believes that the future sales of the products over the next 3 years will be only 75,000, 50,000, and 25,000. The asset will then be sold out, I guess. An offer has been, can you please remove your cursor, sir? An offer has been received to buy the machine immediately for 120,000, but the company will have to pay shipping costs of 2,500. The risk-free market rate of interest is 10%. An impairment review confirms that the assets might have been impaired. Determine the impairment loss.
Okay, so very straightforward question, very, very straightforward. So in this case now, I can see that the focus of the examiner is for me to determine an impairment loss. And in this instance now, I would need to get a carrying amount. I will also need to get a recoverable amount. As soon as I get these two, then that's it. So to get a recoverable amount, to get carrying amount, I was given directly. So I have 150,000 carrying amount, no stress. If they didn't give me, all I need is just my cost minus accumulated depreciation. And if there is any impairment loss that has been charged earlier, I'll deduct that as well to get my carrying amount. So to get my recoverable amount, I would need fair value less cost to sell, which we can also call NRV, net realizable value. Okay, in this case, that I can get in the last paragraph. I was given the fair value, which is the selling price, as 120,000. I was given cost to sell because somebody wants to buy the machine for 120, and there is a shipping cost of 25. So my NRV is that will be 117,500. Correct me if I'm wrong. Then my value in use, okay, my value in use is the present value of future cash flows. So I need to present value my future cash flows using a discount rate. Would need a discount factor. When I multiply this discount factor by the future cash flows, it gives me present value. And they give me that information here. So I was told that, so the company, they gave me future sales over the next 2 years. So it's over the next 3 years, 75, 50, and 25. That means in year one, I'm going to make an inflow of 75,000. In year two, I'll make an inflow of 50,000. In year three, I'll make an inflow of 25,000. And I omitted something here. So I think they said the assets will be eventually sold for. I omitted it, so I'll assume a figure there. Let's say 10,000. So year three, that's the eventual disposal of the assets. That's like the scrap value. So I need to get my discount factor using this risk-free market rates given in the correction of 10%. So at 10%. So who can get me this discount factor at 10% year one? In case you are wondering how to get this DF, is 1 plus R raised to power
Yeah,
minus, okay,
0.909.
3.909.
Year two,
Year 2,
0.826.
year 3,
0.75.
yeah, actually no from year 1 to year 5 offhand. Okay, so what's the difference? What's the multiplication? 75,000 multiplied by 0.909.
68, 175. 68,175.
Year 2.
$41,300.
Year 3.
18,775. 18, sir. 18. 775.
Okay. And this one?
7,500.
Okay.
After.
So what's the total?
One 35,760.
135,750. So the recoverable,
760, sir. Sorry.
760. 760.
Yes.
yeah, thanks. So the recoverable amount is the higher between the NRV, in this case, is 117,500 and value in use, in this case, 135,760. So therefore, the recoverable amount is how much? How much is it? How much is the recoverable amount?
135,760.
760.
Correct. Yeah. So the impairment loss is, I have my recoverable amounts of this and my carrying amounts of how much? 150,000. There's an impairment loss of how much? What's the difference?
14,240.
14,240. So, and that's all this question wants us to do. And that is what we have done exactly. Okay. Let's solve the next question. Now, another person should read this question.
Okay, can I read?
Yes, please.
Okay. Antigenic Manufacturing Limited bought a new machine for its factory in Otago State for 140 million naira on January 1st, 2015. At acquisition, the machine was estimated to have a lifespan of 7 years with no scrap value. The at this, the machine generates largely independent cash flow and therefore is tested for impairment at a standalone asset. Due to a downturn in the economy and reduction, as well as cancellation of major customer orders due to changes in the marketplace, the directors concluded that the machine has been impaired. You are provided with the following information. Fair value of the machine is 60 million naira. Selling cost is 5% of the fair value, and value in use based on discounted future cash flow is 63.5 million naira. Required. Determine if the machine is impaired based on the above information. Calculate, if any, the impairment charge. the directors should take to profit. Calculate if any the impairment charge the director should take to profit or loss.
Thank you. So the first one asks us to determine if the machine is impaired. The second has to calculate the impairments that will be taken to PRL. So this first one, I don't know what the examiner was thinking, asking this type of question that looks so similar. And perhaps they're even the same thing, really. But maybe, I don't know, whatever. So to answer this one will be much of explaining how depreciation or impairment is computed, why this is the actual calculation. So as you can see, the cost of the asset is 140. The useful life is 7 years. The carrying amount is 80. So they give us carrying amount straight on. Then, they gave me some stories here, but I was given fair value. I was given selling costs, and I was given value in use. So of course, this is the higher. So if you're literally looking at it, this is lower than the carrying amount. So the asset is impaired. So yeah, we are now asked to calculate, and they gave you 9 marks. I don't know what's wrong with the guy, but it's okay. So the carrying amount, so an asset, this is the A part that they ask us to determine if the machine is impaired. So a machine is said to be impaired in line with IAS 36 if the carrying amount is higher than the recoverable amounts. And the recoverable amount is the higher between the fair value less cost to sell and the value in use. And the value in use. From the question, the fair value less cost to sell is fair value of how much? 60 million. 60 million. The cost to sell is 5% times 60, which is 3,000. Then the NRV is 57,000. The value in use, as given in the question, is 63.5. That's 63,500. So the recoverable amount is 63,500, being the higher 22. So the carrying amount of 80,000 is higher than the recoverable amount of 63,500, hence the machine is said to be impaired. So the B, where we are asked to calculate impairment loss. So we have a carrying amount of 80. We have a recoverable amount of 63,500. So there is an impairment loss of how much?
16,500.
16,500. Of 16,500. So the total amount of the impairment loss of 16,500 will be recognized to profit or loss for the year unless there is a previous revaluation surplus on the machine. In this case, there is none. So it's totally recognized to pure. Now, another question. We are asked to depreciate between impairment and depreciation. Okay. Is there anyone here that can differentiate between impairment and depreciation? In this class, is there any difference or are they the same? Anyone?
There are different, sir.
Now tell me, what's the difference? What's the difference?
Yeah. Hello, sir.
Yeah.
I just want to try based on my own knowledge. So, knowing fully well that depreciation is the systematic way of allocating the depreciable value of an asset over the useful life, while impairment is loss in the worth of an asset within the measurement period.
Say it again. Say the impairment loss again.
That is the loss in the value of the assets within the measurement period.
Loss in the value of the assets within the measurement period. Okay. Yeah, it's fine. Impairment loss is really a loss in the value, but we want you to describe it in that manner. So, Echo, please don't write this in the exam. Don't write this in the exam. Depreciation is not wear and tear. If you can delete that message, delete it.
Yes, sir.
So,
Yep.
depreciation, yeah, is right. Is right for depreciation. But for impairment loss, I would really want you to explain it the way we have explained it here, which is where is the amount by which the carrying amount of an asset is exceeds or is higher than the recoverable amount of that asset. That's impairment. That's what we mean by impairment. So which also demonstrate that the asset has actually lost some economic power in terms of generating money or in terms of how much you can sell it, right? But depreciation is just a systematic allocation of the costs or depreciable amount of an asset over its estimated useful life. That's the difference. So how do you know? How do you know that there is an impairment, that an impairment has occurred? You see, it's so sweet the way I've explained it very simply that the carrying amount, it should not be higher than recoverable amount and all of that. But in real life, what would prompt anybody to want to determine what would prompt anybody to want to determine revalued amount? Is it that you be determining revalued amount every year, right? So yeah, it makes sense to know about the indicators of impairment. Something must prompt you that, okay, that this asset might be impaired. Something usually prompts us in practice, right? So, and now they're asking you it's in your exam. So there are external indicators. External indicators. Number one is where there is a decline, when there is a decline in the market value of the asset. So if the market value of the asset is declining, that's an indicator of impairment. You know that if Naira is appreciating, for some people, it might indicate that the asset might have impaired because it's especially dollar denominated asset that you bought in dollars. So the value is up, but by the time Naira gains value, well, maybe not, maybe not, maybe not, maybe not. But basically, this is as simple as it is that where the selling price of the asset is going down, then it is an indicator that this asset might have been impaired, or where there is changes in economic or technological, the markets or legal environment in which the assets is located. That's also an impairment and is an external indicator, right? Is external, is a market factor. It's not you determining it. So change in economic environment, technological environment, legal environment can make an asset lose economic value, can show that your asset does not worth what you think it's worth anymore, right? It can do that. So when there is fire outbreak, yes, Ayobami, but that's not external. That's more of internal. It's your cost. It's you that cost it. It's you that cost it. Yeah, eco, yeah, changes in technology. Yeah, we have mentioned it here. I've lumped it together. So another one is where there is an increase in interest rates. Interest rates that is used to determine the value in use of the asset. So if interest rates should increase, you know that the higher the interest rates, the lower the value in use. If you go and check it, if you use a higher interest rates, the value in use you will get to be lower. All right. So if interest rate is rising, it is an indicator that there might be an impairment because the market value, the value in use of assets will be going lower. So it is an indicator as well. Also, where the market capitalization, of an entity is lower than the net assets of the entity. So this is applicable for entities that are listed on the market. Okay. For those entities that are listed on the markets, then where the market capitalization, where it is lower than the net assets, than the book value of that company, then in that case, it is also an indicator. It can indicate that it is impaired, right? Can indicate that is impaired. So then also there are internal indicators. So that is number one is where there is physical obsolescence. Physical obsolescence or damage on the assets. The asset is looking obsolete or there was a damage, either for whatever reason, whether fire outbreak or what have you. Then it is an indicator that there's a problem. Where there is a decline in the productive performance of the assets, a decline in the productive performance of the assets is also an indicator that these assets might have been impaired. Where there is an adverse change in the use of the assets. So the way you are using the asset now, there's an adverse change. You are using it much more than the way you were using it before. An asset that you'd use once in a day, now it's used like multiple times in a day. You should check. The asset might have been impaired and many more like that. So if you know like 5, because in case they ask you a question that can earn you 6 marks, in this case, if you mention 3, you're fine. Also, we're asked to identify an account for impairment of assets. Okay, so how do you identify account? I think we have mentioned that already. So where the carrying amount is higher than its recoverable amount, that is how you identify it. That, okay, there's an impairment. And when you identify, then you would recognize the impairment loss to P&L and also credit the value of the asset. But if there is a previous surplus on the asset, then you would then recognize that to OCI in that case. You recognize that to OCI in that case. So that is how that is treated. We're also told that C, they said a non-current asset in the statement of financial position of Zamfara Limited and SME at the beginning of the financial year had a carrying amount of 800. The asset has previously been revalued and there was a revaluation surplus of 50,000 relating to it in the revaluation reserve. At the end of the financial year, Zamfara suspected that the asset had been impaired. It therefore estimated the recoverable amount to be 600. Depreciation charge on the asset for the year would be 80,000. For the year on the assets would be 80,000. Okay. So we are asked to determine impairment loss. So solution to C. I'm sure every one of you should be able to solve this because they gave me a recoverable amount direct. They didn't even ask me to calculate. They gave you as 600,000 in this second to the last paragraph. And they gave me my carrying amount also. Though they didn't give me that directly, they gave me the carrying amount at the beginning. At the beginning as 800,000. And they gave me depreciation for the year. They gave me depreciation for the year as 80,000. So if I get the difference between the two, which is 720, in this case, there is an impairment loss of 120. So we are asked, as they said, you as the finance manager, explain with relevant computation the accounting treatment in line with. So I've done my calculation. I need to explain. So the impairment loss will be recognized to other comprehensive income to the tune of the previous surplus, because there was a previous surplus of 50,000. So to the extent of the previous revaluation surplus of how much? Of 50,000. So the excess over the previous revaluation surplus of how much? Of 70,000 can then be recognized to profit or loss. So, and that's really how it's going to be, that's how it's going to be treated. And that's for 20 marks. 20 marks. So, I mean, they ask impairment loss a lot in your exam. So, yeah, that is pretty it on depreciation. However, one more thing. So, there's something they call cash generating units. There's something they call cash generating units. So, you see, this cash generating units, so this helps us link the theories of calculating impairment loss as explained above to reality. Yeah, it helps us link it to reality because we have been saying that when the carrying amount of an asset is higher than its recoverable amount, then the asset has been impaired, and recoverable amount is the higher between value in use and fair value. Okay, that's nice. Now, how do you get impairment loss for an asset like furniture and fittings? Yeah. How do you get depreciation? Oh, sorry, impairment loss for an asset like furniture and fittings? You say, that's simple now. We can get the carrying amount. Fine now. That's the book value. Oh, yeah, get us the recoverable amount. Why not? You see, recoverable amount is the fair value. How much you can sell it? I can go and get somebody that wants to buy it. Then I can get the selling price. Okay, fine, no problem. Get the value in use now. Then they will start stammering. Stammering in the sense that, okay, for a furniture, how can you get value in use for a furniture? Because value in use is the present value of future cash flows. So how can you get future cash flows? Does the furniture make money? No, it doesn't on its own. So it's therefore very difficult or impracticable to get value in use for furniture. and you cannot get value in use, you cannot get recoverable amount, because it's really the higher. You need to be able to identify those two figures so that you can pick the higher. So you see, the reality is that a lot of individual assets does not generate cash flows on their own. They don't. A lot. Most assets. So getting value in use to get value in use for such assets or for such individual assets becomes impracticable. Okay, becomes impracticable. So, and if you cannot derive VIU, you cannot calculate impairment loss. So it becomes a problem. And this is where cash generating unit comes in. So according to IAS 36, CGU is the smallest identifiable group of assets that generates cash flows largely independent of other assets. So what this does for us is this. You can group together assets that generates cash flows together. So for example, the old factory is a CGU. So you can't take just one equipment, one production line. You need to look at the entire factory line. It can be a CGU or maybe a retail shop or a retail supermarket. So if you own a supermarket, you cannot say, okay, this my refrigerator or this my generator. No, you need to look at the entire supermarket together and you say, okay, this is my CGU or an operating segment. So you see, the reality is this in real life, for most of these, in calculating impairment loss, for you to say these units generate cash flows together, you are basically looking at the business itself, either a branch or a segment or a factory or a whole shop or a whole branch. That's basically what CGU is. And asset don't make money individually. It's collective. It's the business. All the money that is made is attributable to the business. So in most cases, even in your exam, you might find them giving you a whole business to and when they give you a whole business, you need to see that as a CGU. And on that basis, you then be able to calculate value in use. Then you can then calculate impairment loss. So you see, when CGU is then considered, right? When CGU is then considered, we will then be able to determine VIU, value in use, and then a recoverable amount. So, which can be compared with the total carrying amount of all the assets in the CGU to determine the impairment loss. So the reality is this, determining carrying amount of individual assets now is not a problem. Is VIU that's a challenge. And that's why we need to see the business as CGU, as one, to get VIU, to get future cash flows so that we can discount that to the present value and then be able to get my value in use. When we do that, you will then need to sum all the carrying amount of individual assets together, which are going to compare with recoverable amount. Now, the challenge is this, when you now get, when impairment loss is determined, okay? When impairment loss is determined, the loss relates to more than one asset. So you know that the double entry is debit P&L credit asset. So which asset now? So since it relates to more than one asset, hence the impairment loss needs to be shared or allocated to the individual assets in the CGU. We need to share it. How? How do we share it? In the following order. So this order is particularly important. Number one, you share it first to physically damaged assets. If there is anything like that, you share it, you prioritize those guys, physically damaged asset. Number two, you prioritize goodwill. If you have any goodwill, you prioritize that. And number three, to other assets on a proportional basis. So whatever is remaining, you share it to other assets on a proportional basis. So see, note that when allocating impairment loss, you must not reduce any of the assets to you must not reduce any of the assets below its recoverable amount individually if you can, since each of them cannot get recoverable amounts below its net, but we can get their NRV. So don't reduce any of those assets. So you need to be watching out for their net realizable value. If you reduce it below, then there's a problem, and again, that means you are then understating your assets. Don't let it go below. So you need to be tracking the assets that have net realizable value. You need to be tracking them and ensure that when you are allocating impairment loss, you must not reduce of the assets below its net realizable value. Otherwise, that's a challenge for us. So you see, additionally, where there is a financial asset like trade receivables within within the CG isn't, I mean, you should not allocate impairment loss, you compute impairment loss to the financial assets unless it is the reason, for the impairment loss. Except you can know that the reason why this business has been impaired is because of this trade receivable. Except if you can point to that. Otherwise, it assumes that it is not impaired. And this is also because impairment loss on financial assets is calculated using the principles in IFRS 9 on financial instruments. So we want to leave it, it has its own way of determining impairment loss. So just leave it when you are doing your allocation, just leave it alone. And yeah, that's it about CGU. And it brings bare reality that all of these things you guys have been saying is not real. At the individual asset level, most of these assets don't generate money on their own. So you cannot even get their value in use. So the only way is to put assets together to get value in use, thereafter get recoverable amount. So when this then is derived, you can then get an impairment loss. And when you determine your impairment loss, the loss relates to more than one asset. So the impairment loss needs to be shared or allocated to the individual assets, and in this order. And you need to, when you're allocating, make sure that you don't reduce any of the asset below its NRV. And when there is trade receivables within the CGU, don't allocate to them, except this is the reason for the impairment. Because financial assets, impairment loss on financial assets is calculated using the principles in IFRS, 9 on financial assets. So before I end up, is reversal of impairment loss. So ordinarily, impairment loss is a permanent loss in the value of an asset. The value of an asset is permanent. It's unlike evaluation deficit that is temporary. It is permanent. If you look at the indicators, they are powerful. Physical obsolescence, damage, decline in productive performance, adverse change in the use. So an asset that is damaged, we might not be able to recover in most cases. It might not, that it will affect its performance. So it's a permanent law. However, don't say nothing is impossible. However, it's possible that there can be a reversal of the impairment loss, right? If there are positive indicators of impairment loss, like all of those indicators we mentioned, if we are seeing positivity, like where there is an increase or improvement in the market value of an asset. So if we see that the market value of an asset is going up, yeah, that could be a possible indicator of an impairment loss. Now we say, okay, let us do that and use it to reverse impairment loss. And to reverse an impairment loss, To reverse an impairment loss, you just do a reverse. You credit profit or loss and debit assets, okay? So we credit profit or loss. We credit profit or loss because there had been an earlier loss which has been debited to profit or loss. So to reverse it, you simply credit the profit or loss. Additionally, when impairment loss is reversed, or let me note that's tautology, the reversal should not result in a value that is higher than the original value of the assets for impairment loss. So when you reverse, you don't expect that the new value is now higher than the original value of the assets before the original impairment loss. So for example, let's say the original value of an asset was 200 million, or let's say 200,000. So there was an impairment loss of 50,000. So you bought the asset to its recoverable amount. So you wrote it down to its recoverable amount of 150. So there was a reversal of impairment, okay, by 70. Okay, so this reversal will be limited to 50. So 50K. So that the new value will not be higher than the original value before impairment loss of 200K. So you cannot reverse and say your new value is 220. It's not possible now. You cannot. You limit it, the reversal, to the loss you have made. You cannot reverse more than the earlier loss. No, you cannot. Because your new value cannot be higher than the original value. So disclosure requirements for impairment loss. So disclosure requirement is so easy to pick out because every standard has disclosures. And what disclosure means for every standard is that there are certain breakdown you need to give us in the notes. Okay, that's disclosures breakdown. And also, there are certain explanation you need to make or certain data you need to give us that are not present on the face of the account. So, for example, now, you calculated impairment loss. If you don't tell us the specific assets that was impaired, you will not know. So you need to tell us which assets was impaired. And you need to tell us the nature, what caused the impairment. You need to tell us what was the nature, what was the indicator, the nature of the impairment loss, or the indicator you saw, what prompted you of the impairment loss. You need to tell us, we need to know. Also, you need to tell us the recoverable amount. If you don't tell us, there's no way we can know Okay, that is VIU and NRV. You need to inform us. Also, in calculating the NRV, what's the discount rate used and future cash flows that you estimated? If you don't tell us, nobody would be able to know that. Also, the assets within the CGU, right? And also how the impairment loss was allocated to the assets in the CGU. That's if you had used a CGU. Also, in case the impairment loss does not come in as a line item, so the item within which the impairment loss was treated or was aggregated with. So you need to disclose, give us all of these details. Otherwise, we are not going to, there's no way we are going to identify that ourselves. So there's a simple question that I quickly want to look at. So there's a CGU that comprises building, plant and equipment, goodwill, current assets. So following a recession, an impairment review has estimated that the recoverable amount of the CGU is 25 million. So how do we allocate the impairment loss? So this one basically is talking about allocation of impairment loss. So first, how much is the impairment loss itself? The carrying amount of the entire assets is 33 million. It's 33 million. This one. And not the entire assets is of the CGU because they put them together. They're a group of assets. What's the recoverable amount of the CGU? 25. That means the impairment loss is how much?
8 million.
8. So to allocate, so the allocation of the impairment loss, first, the original value, the impairment loss, then the new value. So I have these assets. I have these assets. What is this? I just scattered. Work. So I have these assets, and I know that the impairment loss is 8 million. First, how do I allocate this impairment loss? First, I allocate to physically damaged assets. In this case, do I have any physically damaged assets? No. Secondly, I will allocate to goodwill. Do I have goodwill? Yes. So how much is my impairment loss in total? 8. How much is the goodwill? 5. Can I allocate everything to it? Yes. So the new value of the goodwill is how much? 0. After which, I should allocate to other assets on a pro rata basis. So other assets. So the building, pro rata is 15 divided by the addition of 15 and 3, which is 18, multiplied by 3. Then the plants and equipment will do the 3 divided by 18 multiplied by the remaining impairment loss. I'm not considering current asset because of what I taught you. Current asset is like a financial asset. So we don't consider them for allocation unless they are the reason for the impairment. And for us to know that, the examiner must tell us that. So otherwise, you ignore them. So what's 15 over 18 times 3? Anybody?
Two point five.
2.5. Then this one will be 0.5. Okay. The way I got this 3, that's the remaining impairment loss. Out of these 8, we have allocated 5 to goodwill to erase the goodwill totally. So the remaining is 3, and that's what I'm sharing based on the values of these other assets. Okay. So I'm allocating 2.5 to this guy, and I'm allocating 0.5 to this guy. So the remaining, this is 12.5. This guy is 2.5. This is 0. Nothing is touching this guy. So it's 10. Of course, if you sum this together, it gives you the 25, because this is 15 plus 10, that's 25. That's the solution to this question. That's solution to this question. I'm going to stop here tonight. I'm going to stop here tonight for you to go and do what you have to do for the rest of your day, especially prepare for work tomorrow. So next week we'll continue. So you're expected to attempt these simple questions, these 2 questions here. Attempt it. There are plenty question on impairment in past questions, plenty. They like asking it. So try this. So next week, I'm going to solve it for you. That's if many of you submit, of course, like we did for today. So I'm going to solve it for you very fast. So next week, we are going to start group account, which I want to finish upper week. So bear with me. We might have extended classes next weekend. I might be starting earlier. I might say let's start 1 p.m. Then I can do like from 1 p.m. straight to 5 p.m. Right? Then we are still going to have the evening classes too. But that one, I will not, the evening classes, today, say I tried, I did 2 hours. It's usually maybe 1.5 hours, less than 2 hours like that, because everybody's tired. Yeah. So we would maximize that next week very well, just so that we can take out that group. For you guys at skills level, group account is nothing serious. It's optional. So I don't want to spend so long on it. So it's optional. But for the professional guys, that background knowledge is so important to you guys, because that is going to be your question 1. That will be your compulsory question. So that in March, I can then focus on your part of group account in March. I want to finish that in March for you guys. Then we can then start in April. I want to have something very, very little to deal with in April. All these extra classes that we are doing, we will not do it in April. We will have very little classes in April. I want to do the hard work now. So by the end of March, for skills, if possible, we should have finished the syllabus. If possible, should have been done with the syllabus. So let's see how possible that is. And let's see how it goes. And also, for some of you that has not been consistent and all of that, in April,
Good evening, sir.
yeah, Joseph,
Yes, sir. I'm on it.
on what?
Yes, sir.
it seems I will remove David or Joseph. So in April, right? But though it is not for you at all because it's like a revision class. We'll be doing an intensive class for FR and SBR to revise everything. So it's not for you. If you wish to join, of course you're welcome, but it's really not for you. To be like a 2 or 3 weeks intensive. We'll do for FR, I'll do for SBR, we'll solve past questions, we would revise everything that we have learned. It will be exam focused. Yeah. That we're going to do for those, majorly the target is for people that have not had time to prepare, but they want to write the exams. So they need something very, very sharp, very smart that they can work with. So we're going to have that package also for whoever wants or that is willing to join that class, but really not for you guys. You guys will have been fully prepared because you have been following the classes all along. You really would not need that. It will be from other set of to be for some other set of people. So yeah, well done, guys. Try and do my assignment. Then let's see where next week takes us. Thank you very much. If you don't have any questions, I'll see you next weekend, and I will see some of you during the week. Thank you very much. Have a wonderful night.
Thank you, sir. Good night.
Thank you, sir. Good night.